So imagine sitting in front of your screen right now, just watching the charts.
Oh, yeah. The tension is palpable.
It really is. Because, I mean, if Bitcoin pumps towards $71,000 today, over $4 billion will be liquidated.
Wow.
Yeah, that is billion with a B.
Yeah.
$4 billion of leverage just, entirely wiped off the board in the blink of an eye.
It is a staggering concentration of capital hanging in the balance. And while it perfectly illustrates the razor's edge that traders walk every single day,
Exactly.
the market is completely binary in these moments. It's brutal. And for the unprepared, losing that capital is just devastating.
Which brings us to why we're here. Welcome to the deep dive. Today, our mission is very specific.
Right, we're diving into the new analysis.
Yeah, we are taking a massive magnifying glass to a really fascinating source document today. It's the latest internal market manifesto and VIP strategy breakdown from Simon, our master trader over at the Paradise team.
It's a great read, really insightful.
But we aren't just going to sit here and read off candlestick patterns. We are diving deep into the psychological warfare of the crypto markets.
Which is where the real game is played, honestly.
For sure.
Yeah.
We're going to separate the professional trading mindset from the gambler's mentality, explore the hidden behavioral biases that cause most people to just lose their shirts in the long run, and most importantly, show you how to actually protect your capital.
I'm glad you brought up capital protection because that concept really has to be the anchor of this entire conversation.
Right.
In this environment, survival is your absolute first objective. Making a profit is, well, it's a distant second.
I completely agree. And building trust, securing long-term wealth. I mean, that is the core philosophy of the MyCryptoParadise family.
It's what we do.
Yeah. This deep dive is entirely about building a fortress around your portfolio, keeping you safe from the noise and the nonsense. So to understand how to survive this environment, you first have to understand what the market actually is.
And Simon has this incredible framework in his manifesto for exactly that.
He does. He doesn't describe the market as some sterile algorithm or just a squiggly line on a graph. He describes it as a breathing organism.
I love that analogy.
Me too. An entity driven entirely by human behavior.
It's a highly visceral way to frame market structure, but it's technically accurate when you look at the mechanics of order flow.
Okay.
I mean, the market breathes.
Yeah.
According to Simon's current structural analysis, the market's inhale represents a move to the downside. It is building pressure, sucking in liquidity, pulling back.
And the exhale.
The exhale is the move to the upside. Right now, he categorizes that as corrective mode. It's this continuous rhythmic cycle of tension and release.
I read that section and I immediately thought of scuba diving.
Oh, that's a good comparison.
Right. Like if you are deep underwater and you suddenly panic, your survival instincts actually work against you. You completely lose control of your breathing.
Yeah, you start taking those sharp, frantic inhales.
Exactly. And if you do that, you drown. Your survival depends entirely on regulating your breath completely, regardless of how dark the water gets around you.
That maps so perfectly to the behavioral science of trading. When retail traders panic because the water gets dark, when the chart turns red, basically, they break their rhythm.
They just freak out.
They do. They act erratically. They market sell at the exact wrong moment. And that panic response is actually what feeds Simon's next major concept.
The predator.
The predator, right. The market is not just an organism. It operates as an apex predator.
This is where the manifesto gets really intense for me. Because the predator isn't just hunting randomly, right? It's actively looking for where everyone is hiding together.
Yes. The predator hunts where the herds are clustered. And the thing is, we don't have to guess where they are. We can literally just look at the liquidation heat maps.
Which is almost unfair when you think about it.
It really is. These maps aggregate the leverage across all the major exchanges and show us exactly where retail traders have placed their stop losses.
And what are they showing right now?
Right now, there are massive glowing clusters of amateur capital sitting between $69,000 and $70,000.
Wow. It's basically a neon sign flashing free lunch for the market.
Pretty much.
I assume this happens because humans are hardwired to look for safety in numbers. Like if an amateur sees a psychological level like 69,000, they think, thousands of other people are putting their stops here, so it must be a really strong level.
Yeah, that's the exact thought process.
But in trading, doing what the herd does literally makes you the bait.
It does. The illusion of safety in numbers is one of the most dangerous cognitive biases a trader can have. When thousands of people place their stop losses in the exact same tight zone, they create a massive pool of liquidity.
And the predator just goes straight for it.
Naturally, it gravitates toward that liquidity. When price touches those stops, it triggers this cascading chain reaction of automated selling, which accelerates the price move even further.
So the predator uses the herd's fear as fuel.
Exactly. And we can see the herd getting incredibly comfortable right now. I mean, Simon points out the Fear and Greed Index, which, by the way, is a free tool you can check right now on MyCryptoParadise.com, is reading a 60 on the 1 hour and 15-minute time frames.
A 60. So what does that actually tell us?
Well, a reading of 60 indicates the market is leaning into greed. It hasn't quite reached that extreme euphoric level of 80 yet.
Because 80 is usually a bad sign, right?
Yeah, when the market hits 80, it often serves as a topping signal. It indicates a reversal is imminent. But a 60 means the herd is feeling a false sense of confidence.
Ah, I see.
They've made a few decent trades, the market has ticked up slightly, and their guard is completely down. The predator thrives when the herd is complacent.
Okay, so if the predator is hungry, and it's already hunting around that 69 to 70,000 mark, it begs the question, why stop there?
Right.
Why wouldn't it just keep sprinting up to 72,000 and eat the herds hiding higher up? Because Simon's data shows there is another liquidation cluster up above 72,000.
It comes down to energy expenditure. Simon notes that the predator will have a significantly harder time hunting at that 72,000 level because, to use his exact phrasing, dogs are guarding the sheep.
The guard dogs. Okay, so we are talking about structural market resistance here.
Yes, exactly. The dogs are formidable supply zones. Specifically, Simon identifies a very strong medium time frame resistance starting at 70,600 and stretching all the way up to 72,000.
That's a huge zone.
It is.
Oh.
And beyond just the historical price structure, there are massive limit orders acting as walls. For instance, he points out a staggering $99 million sell wall sitting around 69,000.
Almost $100 million.
Right. And looking down, there's a colossal $196 million buy wall protecting the downside at 66,900.
Wow.
These are physical barriers of capital meant to absorb the predator's momentum.
Wait, let me stop you there. Because anyone listening who has spent, more than a week in crypto is probably a little skeptical right now.
Oh, I'm sure they are.
We are talking about giant $100 million buy walls. If I see a wall that massive on the order book, my first instinct is that it's completely fake.
And that is a very healthy instinct.
Right. How do we know it's not just a whale spoofing the market, flashing their cash to scare retail into selling with zero intention of actually letting that 100 million order fill?
You are applying the exact critical thinking a professional has to use. Simon explicitly warns about this in his analysis. Those massive walls might very well be whale spoofing.
Which happens all the time.
Constantly. Spoofing is a classic manipulation tactic. A whale places a massive buy order just below the current price to create the illusion of a solid floor. Retail traders see that $196 million wall, feel safe, and just blindly buy in.
And then right before the price drops down to actually hit that order, the whale just hits cancel.
Yep, the floor vanishes.
Retail panics. The price plummets, and the whale scoops up the discounted Bitcoin. It's so predatory. But how do you actually spot the fake? How does the Paradise team validate these walls so they aren't just gambling on an illusion?
Well, validating a wall requires moving well beyond the static order book. You have to analyze real-time order flow dynamics. Professionals look at the velocity of market orders versus limit orders.
Okay, make that simple for me.
If the price is approaching that massive buy wall, but you don't see aggressive market bonding stepping in to front-run it, that is a massive red flag. Furthermore, they analyze order book depth delta.
Meaning if the wall starts to move.
Exactly. If that giant wall starts flickering or incrementally reducing in size as the price gets within 1%, it's almost certainly a spoof.
They're pulling the liquidity before it gets hit.
Precisely. This is why the Paradise team monitors the market 24/7. Relying on a screenshot of a buy wall is a gamble. Continuously analyzing the microstructure of the order flow, that is professional capital protection.
Okay, because these walls are constantly shifting and whales are actively spoofing. Placing a trade right in the middle of all that chaos sounds like walking into a blender.
It really is.
Which brings us to a critical concept Simon outlines for survival, the noise zone.
Ah, yes, the noise zone. That is where amateur accounts go to die.
That's a brutal way to put it, but it's true.
Simon explains that right now, everything between a trader's entry point and that 72,500 level is pure, unadulterated noise.
Just random volatility.
Exactly. It's the byproduct of algorithms fighting each other, whales spoofing orders, and just the natural chaotic breathing of the market we talked about earlier.
And amateurs get completely chewed up by this noise before the real structural move even begins, because they put their stop loss right inside the blender.
Constantly. And they do it because they are terrified of taking a large loss. So they set their stop extremely tight. But in doing so, they mathematically guarantee they will be stopped out by normal market fluctuations.
Yeah.
Professionals, on the other hand, place their stop losses deliberately outside the noise zone. Simon suggests placing a short position stop loss above the 0.618 Fibonacci retracement level at 72,500. Or even higher, safely above a cluster of wicks at 73,270.
Setting your stop loss inside the noise zone is like, well, it's like installing a burglar alarm on your house and setting the sensitivity to absolute maximum.
Oh, that's a perfect analogy.
The alarm just goes off every single time the wind blows or a leaf hits the window, and eventually you lose your mind. You are constantly reacting to false alarms, bleeding money in fees and small losses.
Yeah.
You need the alarm to trigger only when the door's actually kicked in.
That is exactly the point. The ultimate goal of a stop loss is to invalidate your trade thesis, not just to stop the bleeding.
Right.
If you get stopped out, it must be because the market actually proved your directional bias wrong. Like the structure physically changed from bearish to bullish, not just a random fluctuation.
Let's decode that 0.618 Fibonacci retracement for a second. For anyone listening who thinks Fibonacci is just some old Italian mathematician or like a seashell shape, how does it actually apply to setting a stop loss outside the noise?
Sure. A Fibonacci retracement is essentially a mathematical measuring tape for human psychological exhaustion.
I like that.
In trading, markets never move in a straight line. If Bitcoin drops sharply, it will eventually bounce. That's the retracement. The 0.618 level implies the market has retraced about 62% of its previous drop.
Okay.
Historically, if a counter-trend bounce pushes past that 62% mark, it suggests the bounce isn't just a temporary breath, the actual trend is reversing.
Oh, wow. So placing your stop just above that level means you are placing it at the exact point where the market's psychology fundamentally shifts.
Yes. You aren't just picking a random dollar amount you are comfortable losing. You are placing your stop based on the market's mathematical breaking point.
Yet, amateur traders absolutely refuse to do this. I think this connects deeply to behavioral science. Why do people consistently put their stops in the noise zone even when they know better?
It comes down to a deeply rooted behavioral bias known as loss aversion. Psychological studies show that humans feel the pain of a loss twice as intensely as the pleasure of an equivalent gain.
Twice as intensely. That's huge.
It is. We have a profound ego-driven discomfort with being wrong. An amateur trader wants to keep their potential loss artificially tiny so they don't have to face that pain.
Right.
But ironically, in their desperate attempt to avoid one meaningful loss, they subject themselves to death by 1,000 cuts. They take dozens of tiny losses for market noise, slowly bleeding out their entire portfolio.
It's a tragic cycle. And when people get chopped up in that noise zone, their psychology completely breaks.
It really does.
This discomfort with being wrong leads us directly into what I consider the ultimate trap. It's how human emotion warps crypto trading from a calculated profession into a neon-lit casino.
Simon doesn't pull any punches in his manifesto about this. He calls out the social media illusion directly.
It's a necessary intervention, to be honest. The internet is flooded with this toxic narrative, this complete fantasy that you can turn $1,000 into $100,000 overnight using 20x leverage on some meme coin.
Yeah, it preys on people's financial desperation and their lack of systemic discipline.
Exactly. You log on to Twitter and someone is posting a screenshot of a Lamborghini claiming they cracked the code. I really want to channel the heart of the MyCryptoParadise brand here, because our VIP team's absolute core mission is the direct opposite of that.
100%.
It's protecting your capital, not selling a get-rich-quick fantasy. So tell me, why is it so incredibly hard for the average person to just ignore the screenshots and stick to a disciplined, boring system?
Because the amateur strategy is practically engineered by our own brains to deliver constant dopamine hits. Think about the mechanics of how an amateur trades. They take tiny profits very quickly.
Even if the move is just starting.
Right. And why? Not because the chart dictated an exit, but because closing a green trade gives them the immediate emotional validation of a win. It strokes their ego.
They just want to feel smart.
Exactly. Meanwhile, as a trade goes against them, they move their stop loss further away or delete it entirely just to delay the emotional pain of realizing a loss.
So they win small, repeatedly, just to feel good.
They do. They might win for 3 or 4 months straight in a ranging market. They actually start to feel invincible, but mathematically, they are just picking up pennies in front of a steamroller.
It never ends well.
Never. Eventually, one massive rare market move occurs, and because they remove their stop loss, it wipes out their entire portfolio in a single afternoon. The casino always claims its money back from a gambler.
Wow. Okay, so if the gambler's strategy is picking up pennies, how does Simon define the professional edge? Like, what is the actual mechanic of a professional trade?
The professional edge flips that entire psychological model upside down. Professionals maximize their profits precisely during those rare, large market moves.
How so?
They do this by keeping their stop losses tight to their entry, but crucially outside the noise zone, as we just discussed, and leaving their exit targets incredibly wide.
I want to break down incredibly wide. How does a professional calculate an exit target without just guessing how high the price might go?
They target structural liquidity pools. They look for the next major area on the chart where the herd has left their stops or where historical support lies, and they aim for that entire span.
Okay.
They calculate their risk-to-reward ratio rigorously. A professional might risk 1% of their capital to make 3% or 4%. This means they can be mathematically wrong on 60% of their trades and still be highly profitable at the end of the year.
Because their winners are exponentially larger than their small, validated losses.
Exactly. But that requires letting go of the ego. It requires being okay with being wrong 60% of the time, which the amateur brain simply refuses to accept.
Yeah, amateurs confuse luck in a quiet, low-volatility market with actual skill.
That is the crux of the downfall. When the market is chopping sideways, the amateur's strategy of taking tiny profits works. They confuse a favorable environment with trading mastery.
And then the market changes.
Right. They also fall victim to action bias. They feel this overwhelming urge to trade every single day, equating screen time and button clicking with actual productivity. Simon emphasizes a profound reality here.
What's that?
To be professional, you must be emotionally strong enough to sit at your desk, watch the charts, and do absolutely nothing.
Doing nothing has to be the hardest thing in the world for a trader staring at blinking lights.
It is agonizing for an untrained mind. But doing nothing while waiting for a high probability setup to present itself is the ultimate hallmark of professional discipline.
Well, applying that professional edge to today's charts, let's look at Simon's actual technical read on the current market structure. We are looking through the clear, objective lens of a professional now. What are the probabilities he is mapping out?
Currently, Simon is executing bearish trading tactics. He projects the macro trend will continue downward. In his manifesto, he maps out the structural analysis using advanced Elliott wave theory.
Okay, Elliott wave.
Yeah, he's identifying subwaves, WXY corrective waves, double three patterns, and potential running expanding flats or ending diagonals.
Okay, before we completely glaze over those terms, let's decode the jargon a bit. Simon lists WXY corrective waves and double three patterns.
Right.
If we go back to our organism analogy, these are basically complex patterns of the market just holding its breath, right? Like it's stuttering before it continues its main direction.
That's a highly accurate way to visualize it. Markets don't just drop straight down, they consolidate. A WXY wave or a double three is a complex consolidation.
So it's just pausing.
It's the market pausing, trapping both early buyers and late sellers in a tight range, building up kinetic energy before the next major move.
And he mentions running expanding flats. I imagine that's when the market actually tries to fake out both sides.
Precisely. It's the market faking a violent gasp of air. In an expanding flat, the price will briefly break the previous high, tricking the herd into thinking a massive bull run is starting.
Ah, the trap.
Yep. The herd buys the breakout, the predator swallows their liquidity, and then the market immediately reverses and dumps below the previous low.
Brutal.
It's designed to liquidate everyone. Simon is tracking these complex corrective structures to anticipate the next major directional push, which he identifies as a fifth wave inhale to the downside.
And the targets for that fifth wave inhale are, well, they're serious drops. He's looking at significant support levels. 54,000, then 49,000, and finally all the way down to 44,000.
Yes.
He isn't just throwing darts at a board, you know. He's mapping this out based on strict probabilities.
The focus on probabilities is what separates the system from a gamble. He ranks the scenarios. The highest probability scenario, based on the current data, is a continuation of the bearish trend down to those lower targets.
Okay, so that's the base case.
Right. A moderate probability is a quick wick up, a brief spike in price, solely to liquidate the herd clustered at 69,000 before violently rejecting and dropping.
Eating the herd.
Exactly. And the lowest probability scenario is a sustained break above the resistance at 72,000, which would structurally flip the market from bearish to bullish.
I really just marvel at that precision. He isn't guessing. He isn't hoping. He is laying out a definitive protocol for every possible outcome.
This is what a true trading system looks like. It completely removes emotion from the equation. You don't sit in front of your screen sweating, hoping the market goes up so your altcoin bags print money.
Right.
You simply react to whichever probability begins to unfold. If the lowest probability scenario happens and Bitcoin cleanly breaks 72,000, a professional doesn't get angry that their bearish thesis was wrong.
They just adapt.
They simply accept the data, pivot, and execute their bullish strategy.
Because they already have a plan for it. That is the fortress around your wealth that MyCryptoParadise talks about. It's not about predicting the future with some crystal ball. It's about having impenetrable armor and a protocol for whatever the market predator decides to do next.
The protocol is everything. It ensures you dictate the terms of your risk rather than letting the market dictate your emotional state.
For sure. Well, as we wrap up this deep dive into Simon's manifesto, I want to leave you with his exact trading mantra.
Oh, this is powerful.
It is. This is something every trader listening should probably have printed out and taped to their monitor. Simon writes, "I think in probabilities, not emotions. Losses are feedback that sharpen my strategy, and wins are the result of disciplined execution, detached from outcomes."
Being detached from outcomes is the hardest yet most liberating state a trader can achieve. You execute your system perfectly, you manage your risk, and whatever the market does next is entirely out of your hands.
You find peace in the discipline.
Exactly.
It's brilliant. And it perfectly encapsulates why this disciplined, capital-first mindset is the lifeblood of MyCryptoParadise. We aren't racing to buy a Lamborghini. We're building an unshakable fortress around our wealth, day by day, trade by disciplined trade.
It really forces you to look objectively at your own actions in the market.
It really does.
Yeah.
So as you close out of your charts today, we want to leave you with one final provocative thought to mull over. We've established that the market acts as a predator hunting human emotion.
Right.
But as the crypto landscape evolves, algorithmic AI bots are increasingly taking over the order books, trading millions of times a second, with absolutely zero fear, zero greed, and zero ego.
That's a scary thought.
Yeah. Does the injection of emotionless AI make the predator infinitely deadlier to the average retail trader? Or does adopting a robotic, disciplined human system like Simon's become the only possible way for humans to beat the machines at their own game?